Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hi everyone, this is Steve and welcome to today's edition of our Through the Noise podcast. Last week we launched our H2 Outlook outlining our views across different asset classes and proposing our stay calm and carry on approach to navigating financial market risks and opportunities. With me here today, I have Abhilash Narayan, our Senior Investment Strategist, to share our views on the outlook for different currencies. So Abhilash, I guess we should start at the top with the US dollar outlook. Heading into the year, we were on the bearish side of the dollar outlook. However, year to date, it's largely flat. So what's our outlook for the dollar going forward?
Hello, Steve. Great being back to talk about our views. And you're right. If you look at the US dollar, it's largely unchanged compared to where we were at start of the year. However, that does not tell the complete picture. The path for US dollar has not been linear, and the dollar has traded in a relatively wide range of around 5% over the past 6 months. Now, looking ahead, we expect the dollar to be range-bound over a 3-month horizon before it resumes its decline over the next 3 to 12 months. So let's start by focusing and digging a bit more into the 3-month view. So first of all, we think that the Fed's recent guidance for more rate hikes, the resilient job market in US, and the sticky inflation means that 2-year US government bond yields are likely to remain elevated, supporting the dollar in the near term. Additionally, the decline in US and global liquidity due to a combination of ongoing reduction in central bank balance sheets as well as US Treasury refilling its cash reserves is also supportive for the dollar on the next 1 to 3 month horizon. So a combination of these factors should keep dollar range bound. However, if we shift our focus to the 12-month horizon, we still expect a high likelihood of a recession in US. And if that view plays out, we expect the Fed to start cutting rates sooner than the current guidance. And as a result, we expect both the 2-year and 10-year US government bond yields to decline substantially over the next 12 months. Now that should lead to a narrowing of interest rate differentials and push US dollar lower by around 2 to 3%.
Okay, so we expect the dollar to decline, but not by a large magnitude. Let's look at individual currency pairs. So in Europe, let's start with the euro. What's your view there?
That's a great point. And while we're still expecting the euro to strengthen versus the dollar, our modest downside view for the dollar also means that we have marginally lowered our 12-month forecast for the euro. So now we are expecting the euro dollar to appreciate modestly towards 1.10 to 1.12 range over the next 3 months before settling into a range. Now, we believe that ECB will continue to hike rates over the next few months and then pause, unlike the Fed, where we expect to cut rates. So the pause stance or the new hold stance for ECB should be supportive for the euro. However, if you look at the technical aspect, the long speculative positioning and the diminishing returns from the dip in energy prices means that the appreciation potential for the euro is likely to be limited. Euro is also a currency which is quite sensitive to risk sentiment, and that means that unless we see an upside surprise in the region's growth, euro is unlikely to appreciate a lot from where we are today.
Let's look elsewhere in Europe. I noticed that you're expecting sort of slightly different trajectory for the Swiss franc and the sterling versus the US dollar compared to what you're seeing on the euro. Why do you expect the trajectories to differ?
Well, in our assessment, we think that the somewhat extreme market expectations are the key driver for the divergent views on the pound and the Swiss franc. So let's start with your country, Steve, the UK. So if you look at UK, clearly the inflation remains uncomfortably high for policymakers. But when we look at the market pricing, markets are expecting an excessive degree of rate hikes, in our opinion, expecting Bank of England to raise rates towards 6.25%. So when we look at that expectation built into the markets and combine that with the downside risk to UK's economy, especially given the softness in housing market, we think that in reality, Bank of England may hike less than expected. And that should lead to a decline in the gilt yields, which combined with the normalization of elevated speculative positioning should lead the pound to decline towards 1.24 to 1.26 range over the next 12 months. The outlook for dollar Swiss is a bit more balanced, and we think that it should trade around 0.90 over the next 3 and 12 months. Now, if you look at the inflation in Switzerland, that has steadily declined, and the latest data shows that inflation has fallen to 1.7%, which is well below the 2% target that Swiss National Bank has. So we think that there is an elevated risk that Swiss National Bank pauses in the coming months. The second factor why we are more range bound on the Swiss franc is a less bullish euro forecast, which also reduces the pressure on Swiss National Bank to be hawkish, given that SNB focuses on euro CHF as a level to manage to curb the imported inflation.
Okay, so what you've outlined so far is pretty boring, to be honest. It sounds very range bound, not too much direction. Are there any currency pairs where you're expecting a large move?
Absolutely. So we are quite bullish on the yen, and we expect it to decline towards 130, which would equate to around 10% appreciation over the next 12 months. That being said, the path to yen appreciation is unlikely to be smooth. So over the next 3 months, given our range-bound dollar view and the lack of signs of BOJ policy normalization, we think that dollar yen could trade around 140 or thereabouts. However, given the fact that inflation in Japan is elevated, we have seen a recent round of wage hikes, and the nominal growth is quite healthy. We think that there is a significant pressure on Bank of Japan to tweak or even scrap its yield curve control policy, and once that happens, that could spark a sharp move lower in dollar yen. Now, this combined with our expectation of lower US bond yields leads us to expect dollar yen to decline towards 125 to 130 over the next 12 months.
Okay, I guess that's a good segue to Asia. So can you give some views on the outlook for the Chinese renminbi, Indian rupee and Singapore dollar?
Well, by and large, we expect modest appreciation for most Asian currencies. Let's start with Chinese renminbi. So we expect that in the near term, there could be a bit more pressure on dollar CNH, and the pair could trade around 7.2, possibly even touching 7.3. As the recent easing from PBOC means that the interest rate differentials have widened against the CNH. However, on a 12-month horizon, we expect dollar CNH to decline towards 7.08 as CNH starts to benefit from robust domestic growth and potential investor inflows. Shifting our focus to Indian rupee, we expect dollar INR to decline modestly towards 80 to 81 range over the next 12 months. Now, in terms of key drivers, Indian rupee should benefit from broad dollar weakness, strong domestic growth, and the decline in current account deficit. However, we think that as we head into 2024, investors will demand a slightly greater risk premium ahead of the general elections, and there's also the risk that RBI uses any FX strength to rebuild the FX reserves. Last but not the least, we expect dollar Sing to decline modestly towards 1.30 to 1.32 over the next 12 months, as MAS is likely to maintain its tightening bias as far as monetary policy is concerned, and the Singapore dollar NIR basket should benefit from appreciation of euro, Malaysian ringgit, and the Chinese renminbi.
Okay, well, thanks, Abhilash, for walking us through the H2 outlook for currency markets. Listeners, I hope you enjoyed the final instalment of our mini-series relating to the H2 outlook. Please do not forget to like and subscribe to this SC Money Insights channel. Alternatively, you can find us on SC Wealth Insights on Facebook, LinkedIn, as well as YouTube. In the meantime, please keep calm and carry on investing.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.